So, when we think about what makes a company successful, our minds usually jump straight to profit, right? But here's the thing, profit is the marathon. What about the sprint? A company's ability to survive right now, to pay its bills tomorrow, next week, next month, that is a completely different ballgame. And that's exactly what we're digging into today, the one metric that acts as a company's short-term financial pulse check. All right, so here's how we're going to break this down. First, we'll get a feel for a company's financial pulse. Then, we'll decode the ratio itself. After that, we'll learn how to read the signals it sends, understand why context is everything, and finally, we'll look beyond that first glance to see its limitations.
So, let's jump right in. A company's pulse. Why do we even have to look past profit? Well, it all comes down to the pretty brutal reality of day-to-day survival in business.
Let me ask you this. Can a company be wildly profitable and still go completely bankrupt? The answer is a huge, resounding yes. It happens way more than you think. Imagine a company that's making millions in sales, all on paper, looking fantastic. But what if the cash from those sales isn't due to arrive for another 90 days and payroll is due this Friday? You see the problem. That gap right there between earning the money and actually having the cash in hand, that's where businesses either live or die. And this is exactly where working capital comes into the picture. Now, forget the dry textbook definition for a second. Just think of it like a company's operational checking account. It's the cash buffer it has to pay its suppliers, to make payroll, to keep the lights on. It is the absolute essential fund that makes sure the day-to-day machine keeps humming along without any hiccups. Okay, so now that we've got a handle on the idea of working capital, let's actually decode the ratio itself. And to do that, we need to pull back the curtain and take a look at a company's balance sheet. It really just boils down to a simple balance. On one side of the scale, you have your current assets. Think of this as all the stuff a company has that's expected to turn into cold hard cash within a year. You've got actual cash, of course, but also things like accounts receivable. That's just a fancy term for the IOUs from your customers and all the inventory sitting in the warehouse waiting to be sold. Then, on the other side of the scale, you've got current liabilities. These are all the bills that are due within that same year. It's what you owe your suppliers, any short-term loans. It's really a classic showdown, what you've got coming in versus what you've got going out. And this slide right here highlights a really, really critical distinction. See, if you just subtract the liabilities from the assets, you get something called net working capital. That's a raw dollar amount. It's super important for a company's own internal treasurer because it tells them how much cash do we need on hand. But for us as analysts, dividing them gives us the working capital ratio. And that answers a much more powerful question: how safe is this company? It's a relational metric that lets us compare a tiny startup to a global giant on totally equal footing. So now we have our ratio. It's just a number, right? Maybe it's 2.0 or 1.5 or maybe a kind of scary zero point 0.8. The question is, what story is that number actually telling us? Is the company healthy, inefficient, or in real danger? Well, generally speaking, the sweet spot, the healthy range, is somewhere between 1.5 and 2.0. This means the company has about $1.50 to $2 in short-term assets for every single dollar of bills it has coming due. That's a nice, comfortable buffer. Now, if the ratio is way up above 2.0, sure, the company is very safe, but it could also be a sign of inefficiency. Maybe too much cash is just sitting around doing nothing, or inventory is just piling up and not being sold. And what if it's below 1.0? Well, that is usually a big flashing warning sign, but not always.
And this is where the simple rules start to break down, and things get really interesting. Some of the most dominant companies in the world actually operate with a ratio below 1.0. Think about a giant online retailer. They get your cash the instant you click buy, but they might not have to pay their suppliers for 60 or even 90 days. So for that entire time, they're literally using their suppliers' money for free to fund their own operations. What looks like a red flag is actually a sign of incredible market power and hyper-efficiency.
And that brings us to a crucial point, maybe one of the biggest rules in all of finance. You can't analyze this ratio in a vacuum. A number that screams danger in one industry might actually mean peak performance in another. Context is absolutely king. Just take a look at this chart. The difference is night and day, right? An asset management firm has a ratio way up over 3. They need a massive liquid buffer to deal with market swings. Then you've got an aerospace company building jets over many years with a high ratio around 2.5. But then look way down at the other end. You've got airlines with a ratio of just 0.57. They can totally get away with this because they use that hyper-efficient model we just talked about. They get your cash for a plane ticket months before you ever step foot on the plane. Look, the working capital ratio is a fantastic first step, an amazing tool, but it's not perfect. It has blind spots. And to be a really sharp analyst, you have to know what a metric doesn't tell you. And there are 3 main blind spots here. First, it's just a snapshot. It's one photo taken on one day of the year, so it can totally miss huge seasonal swings. Second, and this is a big one, it ignores asset quality. It treats a warehouse full of last decade's flip phones exactly the same as a pile of cash. And third, companies can sometimes window dress their finances. Delay paying some bills or sell off assets right before the quarter ends just to make the ratio look a little better than it really is. So to get around that big inventory problem, analysts use a much tougher, much stricter metric, the quick ratio. Some people call it the acid test. It's simple, but it's kind of brutal. It calculates the ratio all over again, but this time it just completely removes inventory from the equation. It's designed to answer the ultimate crisis question. If sales suddenly drop to 0 tomorrow, could this company still pay its bills? The answer to that gives you a much clearer picture of true immediate financial health. So as we wrap this up, this is the core tension, the fundamental challenge that every single business faces. Do you keep a huge pile of cash on hand for safety, even though it's earning basically 0 return? Or do you run an ultra-lean, super-efficient operation that maximizes profit but leaves you incredibly vulnerable to the slightest disruption? Finding the perfect balance on that tightrope? Well, that isn't just a math problem. That is the true art of great financial management.